5 months ago, silver did something it had never done in recorded history. It crossed $121 an ounce for the first time ever. And right now, today, June 25th, 2026, that same metal is sitting below $60, a 50% drop from the all-time high, in one of the fastest corrections this market has ever seen. But here's the part that makes this story genuinely interesting. The supply deficit that helped drive silver to that record high, it is still there. In fact, it is getting wider. The war that sparked the inflation that triggered the sell-off, a peace deal was just signed. Oil has already crashed back toward pre-conflict levels, and yet silver keeps falling. So the question everyone is asking right now is the right question. Is this the end of the silver story? Or is this one of those brutal, painful, gut-wrenching corrections that ultimately sets up the next move higher? Because the data tells a very specific story, and the story is not what most people think it is. Before we go any further, I want to ask you something. When you see an asset fall 50% from its all-time high, what is your first instinct? Most people assume the story is finished. The thesis is broken. Move on. But throughout this entire silver bull market, that same instinct has been wrong. Every single time. So before you assume this correction is different, stay with me, because what the numbers are actually showing right now deserves a much closer look. Let us start with what actually happened, because the decline from $121 to where we are today is not one story. It is two completely separate stories that most commentary is treating as if they are the same thing. And that distinction matters enormously if you are trying to understand where silver goes from here. The first phase started in February and ran through most of June. It had a clear, identifiable cause. The conflict between the United States and Iran, which began at the end of February 2026, sent oil prices surging above $100 a barrel. That energy shock pushed headline inflation in May to 4.2% year over year, the highest level in years. The Federal Reserve, under its new chair, Kevin Warsh, responded exactly as you would expect a hawkish central bank to respond. At the June 16th and 17th FOMC meeting, Warsh's very first as chair, the Fed held rates steady but sent a very clear signal. 9 of 18 committee members are now projecting at least one rate hike before the end of this year. Markets are currently pricing a roughly 2/3 probability of that hike actually happening. When interest rate expectations rise like that, non-yielding assets like silver face a real headwind. Why hold a metal that pays nothing when Treasury yields are competing with a potential 4.5% or higher? That is a genuine, rational mechanism. It produced a genuine, rational decline, and it explains most of Phase 1. But here is where the story becomes more interesting, because Phase 2 is happening right now, this week, and it has an almost entirely different cause. The Iran-US peace framework was signed. Oil has already plunged more than 17% over 6 consecutive sessions. WTI crude is trading near $73 a barrel, close to pre-conflict levels. The exact development that was supposed to relieve inflationary pressure has already happened. The war ended, oil fell, and yet silver fell nearly 5.4% in a single session just yesterday. Gold fell too, but only about 1.7%. That gap between silver and gold in the same session is the most diagnostic data point available right now. If this were purely a story about the Fed crushing precious metals, you would expect both metals to fall roughly proportionally. They are not. Silver is falling 3 times as fast as gold, and that asymmetry has a very specific explanation. When tech stocks dropped sharply earlier this week, institutional funds needed to raise cash quickly. They looked at their portfolios and asked the same question they always ask. What is liquid? What has gone up recently? And what can I sell right now? Silver had rallied over 150% in 2025 before its peak in January. It is highly liquid. It got sold. Not because of anything wrong with silver's story, but because a margin call in a completely different asset class needed to be covered. This is what the gold-silver ratio is measuring right now. As of yesterday, June 24th, it takes approximately 65 to 67 ounces of silver to buy 1 ounce of gold. That compares to just 46 to 50 ounces back in January when silver hit its all-time high. The ratio expanding this sharply and this quickly is a fingerprint. It tells you that the selling pressure hitting silver disproportionately is the kind of short-term, forced paper market liquidation that has nothing to do with the underlying structural thesis. Now here is the part most people are ignoring. Forced selling has one defining characteristic. It is finite. A fund that sold silver this week to cover a tech position has, by Thursday morning, already raised that cash. The selling is done. The pressure has been relieved. And what is left behind is a silver price marked down by a mechanism that was never about silver in the first place, sitting near its lowest level in 7 months, against a backdrop where the primary macro headwind, the Iran war and its oil shock, has already dramatically reversed. There is a pattern here that has appeared multiple times in this entire multi-year bull cycle, and understanding it is the difference between making a rational assessment and panicking at the wrong moment. Look back at what happened in late 2025. The gold-silver ratio expanded significantly during periods of elevated rate expectations and risk-off selling. And in each of those cases, when the ratio eventually compressed back toward the 50s and 60s, it was because silver's industrial engine and its investment demand combined to push silver significantly higher. The ratio is not a timer, but historically in this cycle, when it has been at or above current levels, it has preceded some of silver's most dramatic upside moves. That does not mean it will happen again. What it does mean is that the ratio is not signaling structural deterioration. It is signaling temporary mechanism-driven dislocation. Now I want to pause here for a moment, because what I am sharing with you in this video is the kind of analysis that takes real research to put together. We are digging into the supply data, the inflation mechanics, the Fed's actual preferred inflation measure, and the historical ratio patterns, all of it in one place. If this kind of original data-driven content is useful to you, consider subscribing right now. We do not cover the noise, we cover the actual story. And right now, the actual story on silver is more nuanced, and frankly more interesting, than almost anything else in the market. So let us go deeper into the structural side of this, because there is a number buried in the supply data that completely changes the foundation of how you should think about silver right now, and almost no mainstream commentary is discussing it. According to the Silver Institute's World Silver Survey for 2026, released in April, the global silver market is heading into its 6th consecutive year of supply deficit. The projected shortfall for this year is 46.3 million troy ounces. That is wider than the 40.3 million ounce deficit in 2025. And here is the number that puts all of this in context. Since 2021, the world has drawn down 762.1 million troy ounces from above-ground silver stocks to cover the gap between what is mined and what is consumed. 762 million ounces. That is roughly equivalent to an entire year of global silver mine production, consumed from reserves, over 5 years, while demand continued to grow. And this is where the supply story gets really important, because you might think, well, prices have risen dramatically, why isn't the mining industry just producing more? The answer reveals something fundamental about how this market works. Approximately 70 to 80% of the world's silver is not produced by silver mines. It is produced as a byproduct of copper mining, lead mining, and zinc mining, which means silver supply does not respond to the silver price the way a normal commodity supply chain would. When silver hits $121 an ounce, copper miners do not suddenly decide to become silver miners. They keep making decisions based on copper. And that structural reality means mine production for 2026 is expected to be essentially flat, growing less than 1%, even as demand continues to outpace supply. The easy supply response has already been used. What is left is inelastic, slow to grow, and fundamentally unable to close a deficit that has been widening for 6 straight years. Now here is where the solar narrative gets complicated in an interesting way. You have probably heard the bull case for silver described as solar panels will consume all of the silver. The global energy transition will drive insatiable demand. And yes, the solar sector has been an enormous driver. But here is what the more nuanced version of that story looks like. Solar photovoltaic manufacturers have been actively working to reduce the amount of silver used per panel because silver is the most expensive material in the bill of materials. That thrifting effort has had a real effect, reducing silver intensity per panel measurably over the past 2 years. And yet, despite that reduction, the market is still running a widening deficit because mine supply is not growing fast enough to offset demand across the full landscape, including EVs, AI infrastructure, electronics, and medical devices. The bull case for silver does not depend on solar consuming ever-increasing amounts of silver per panel. It only requires that mine supply stays constrained, which it is, and that total demand across all categories holds steady or continues to grow, which it is. That is actually a stronger structural foundation than the simpler version of the story. It does not need solar demand to be infinite. It needs the supply side to stay broken, which it is. Now here's the question nobody is asking. If the structural deficit is real, if the supply side is structurally constrained, and if the primary macro headwind that drove the first phase of this decline has already visibly reversed, then what exactly is the market pricing right now at $57 to $59 an ounce? This is where the PCE data dropping this morning at 8:30 a.m. Eastern becomes the most important single data point for silver's near-term direction. And understanding why requires understanding the difference between two inflation measures that the media often uses interchangeably, but that are actually quite different. The CPI, the Consumer Price Index, is the number you hear about on television. It came in at 4.2% for May. That is the number that spooked the Fed committee into projecting rate hikes. That is the number that most of the negative market commentary is reacting to. But there is a critical piece of context embedded in that 4.2% that most of the commentary leaves out. More than 60% of May's monthly CPI increase came directly from energy prices tied to the Iran war. It was not wages pushing prices up across the board. It was gasoline and jet fuel and utility costs responding to a war that closed one of the world's most important oil shipping lanes. The PCE, the Personal Consumption Expenditure Index, is what the Federal Reserve actually uses when setting policy. It measures inflation differently, including adjusting for consumer behavior changes and weighting categories differently than CPI does. Consensus estimates going into this morning's release have headline PCE at approximately 4.1% year over year, very close to the CPI. But core PCE, which strips out food and energy, is expected to come in around 3.3 to 3.4%. That gap between the 4.1% headline and the 3.3% core is the crack in the hawkish narrative. Because here is the mechanism that matters. The headline number that 9 Fed committee members cited as justification for projecting rate hikes was being driven primarily by oil. And as of this morning, WTI crude is trading near $73 a barrel, down roughly 17% since the peace deal was signed. If energy prices have already dropped this sharply before the June PCE data is even calculated, and they have, then the July PCE reading is going to look dramatically different from today's report. The inflation data the market is currently reacting to is already backward-looking relative to where prices actually are right now. This is a structural argument for why Deutsche Bank's scenario, which requires 3 to 4 Fed rate hikes this year, is a tail risk, not a base case. That level of tightening would require the Fed to raise rates aggressively into a rapidly falling energy price environment. The war ended, oil fell. The inflationary pressure that justified the hawkish pivot is already deflating in real time. A data-dependent central bank, even a hawkish one, responds to the data. And the data is about to start reflecting a world without oil at $100. Now, the institutional downgrades are real, and they deserve to be taken seriously. Bank of America previously had a gold target of $6,000 per ounce. They have now revised that lower, citing an uncomfortable inflation backdrop. Goldman Sachs has cut its year-end gold forecast to $4,900. Deutsche Bank is projecting 2 Fed rate hikes this year and has set a third-quarter gold target of $4,300, with a risk scenario of $3,800 if 3 to 4 hikes materialize. These are serious research teams. Their analysis is worth reading. But there is a pattern in how commodity downgrades work that is worth understanding, and it has nothing to do with dismissing the banks. Institutional analysts update their models based on incoming data. The data that drove these downgrades, a 4.2% CPI, a hawkish FOMC meeting, a dollar index pushing above 100, that data was already embedded in market prices before the notes were published, and before the strategists appeared on financial television to explain the revision. The downgrade reflects a reality that already happened. The question for investors is what reality comes next. Bank of America's gold target was $6,000 when gold was near $4,800. Gold is now around $4,000. The downgrade is responding to the move, not predicting it. And the scenario that would validate Deutsche Bank's most bearish projection requires the peace deal to collapse and oil to respike above $100, while the Fed simultaneously hikes 3 to 4 times. At this exact moment, the ceasefire is holding, and oil is at $73. What the year-end analyst survey and metals focus project for silver in a bull case scenario is a range of roughly $83 to $97. The path from current levels to that range over a 6-month window does not require extraordinary assumptions. It requires the ceasefire to hold, which it currently is, and energy prices to keep declining or stabilize at current levels, which they currently are, and the PCE data to confirm that the inflationary spike was primarily energy-driven and therefore temporary, which the composition of the data strongly suggests. That arithmetic is not a guarantee, but it is the logical outcome of two engines, the monetary engine and the industrial engine, both restarting from a simultaneously depressed base. So what should you actually be watching right now? This is the part that matters most for the immediate term. Today's PCE release is the first live test of whether the hawkish rate narrative holds or starts to lose credibility. If the core PCE number comes in near or below 3.3%, the Fed's own preferred inflation gauge is going to show underlying price pressure meaningfully below the headline figure that 9 committee members cited when projecting hikes. That gap between a 4.1% headline driven by energy and a 3.3% core reflecting non-energy prices creates a real policy dilemma. You cannot credibly justify hiking aggressively into falling energy prices when the core measure you actually target is already well below the headline. Rate hike probability, currently sitting near 2/3, should start drifting lower as that message is absorbed. If PCE comes in hot, above 4.1% on the headline and above 3.5% on the core, the hawkish case holds for another few weeks, and silver tests the lower end of recent trading ranges. That would be uncomfortable. But even that uncomfortable scenario is happening against a backdrop where the peace deal is signed, oil is near $73, and the supply deficit is in its 6th consecutive year. Anyone buying into continued weakness in that environment is buying into progressively stronger physical market support, not weaker. The 52-week range for silver spans from around $35 an ounce at the low to $121 at the January peak. Where we are right now, in the high 50s, sits in roughly the lower 20% of that range. Think about what that means. Silver is near a 7-month low at a price level that, 12 months ago, would have represented a multi-year high. The multi-year structural bull market is still intact. What changed is the near-term macro environment. And the near-term macro environment is changing again, back in the direction that is more supportive for silver, in real time, today. Here is the honest summary of what actually happened to this rally, and why the word interrupted is more accurate than the word killed. 3 separate forces hit silver simultaneously. The first was a genuine monetary repricing. Warsh's hawkish dot plot was real, and it created a real headwind for non-yielding assets. That is the component most analysis focuses on. The second was geopolitical de-escalation, removing the safe haven premium before the industrial engine had time to restart. Peace deals are complicated. The Strait of Hormuz takes months to fully normalize shipping flows even after the framework is signed. The timing mismatch between the safe haven premium coming out immediately and the industrial demand recovery arriving gradually created a gap that silver's price fell through. Both of those forces are now partially or fully reversing. The third force is the one that does not belong in any long-term thesis, but is doing meaningful short-term damage. Contagion selling from tech. When institutional funds get margin called in growth equities and need to raise cash urgently, they sell what is liquid and what has worked. Silver had risen more than 150% in 2025. It is extremely liquid. It got sold. This is mechanical. It is not a verdict on silver's story. And historically, every time this pattern has appeared in silver's trading history, in this cycle and in prior cycles, it has resolved when the forced selling ran out of fuel. Because forced selling is, by definition, temporary. The fund either covers its position or doesn't. Either way, the pressure ends. There is a difference between a rally that was fundamentally wrong and a rally that was interrupted by forces that have nothing to do with its foundation. The structural supply deficit has not changed. The industrial demand from EVs, AI infrastructure, and electronics has not changed. The cumulative 762 million ounce drawdown from above-ground stocks has not changed. The mine supply that cannot grow fast enough to close the gap has not changed. What changed was a war, the inflation it caused, a Federal Reserve that responded to that inflation, and a tech-driven margin call that created forced liquidation in the wrong asset. 3 of those 4 factors are now reversing. The fourth, the Fed, is about to get new data that materially changes the calculus. Before we close, I want to ask you one final question, because it is the most important one in this entire discussion. Not, will silver go back to $121? That question is unanswerable right now, and anyone who tells you otherwise is guessing. The real question is simpler and more useful. Have the reasons that created the original structural bull case in silver, the supply deficit, the industrial demand, the monetary debasement, the above-ground stock drawdown, have any of those fundamental reasons actually gone away? Look at the data. 6 consecutive supply deficits. 762 million ounces of cumulative above-ground stock drawn down since 2021. Mine production essentially flat despite a 150% price rally, because 75% of supply is locked to base metal economics. Industrial demand holding across EVs, AI infrastructure, and electronics, even as solar thrifts per panel usage. A Federal Reserve that has held rates and whose hawkish projections are built on an energy shock that is already visibly reversing. You make the call, but make it on the data, not on the narrative. Tell me in the comments what you think. Are we watching a structural breakdown in the silver bull case? Or is this an interruption that sets up the next move? I read every comment and I want to know where you stand. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in.